Dividend ETFs are favored by investors who want to have broad exposure to the stock market while minimizing their risk levels. Because dividend ETFs hold many different stocks, they allow investors to have diverse holdings without having to track the performance of each individual company. If you're seeking high yields in the ETF space, we're going to take a look at the 10 highest yielding ETF options available today. All of these dividend ETFs pay more than a 10% dividend yield right now, and we're listing them from lowest to highest. Number 1. TYD with an 11% dividend yield. The Direxion Daily 7 to 10 year Treasury Bull 3X is an ETF trading under the symbol TYD. With TYD, it's important to note that due to its structure, it's intended to provide a 300% return relative to its benchmark index for the day. TYD should not be expected to provide this performance for periods greater than 1 day. And this ETF comes with an expense ratio of 1%. As mentioned, TYD offers an annual dividend yield of 11.01% paid out on a quarterly basis. This ETF offers 3 times long leverage exposure to the New York Stock Exchange current 7 to 10 year U.S. Treasury bond index. This is good for investors with a bullish and short-term outlook for U.S. 7 to 10 year Treasury bonds. This ETF is geared towards investors with a close, detailed, and up-to-date understanding of the U.S. economy. This is not an ideal ETF for investors who are looking for a buy and hold strategy. But that does make this ETF a pretty good candidate for the dividend capture strategy. The latest TYD holdings are shown on the screen here and are currently spread across a number of Treasury bond ETFs. Number 2, QYLD with a yield of 11.27%. The Global X NASDAQ 100 covered call ETF trades under the symbol QYLD, or QYLD. QYLD currently offers over an 11% annual dividend yield, which is paid out in monthly dividend payments. According to Global X, there are a few reasons to consider QYLD as an investment. 1, it has high income potential through its covered call strategy. 2, it's made monthly distributions for 8 years running. And 3, it gives investors easy exposure to options trading as the fund will execute them on the investor's behalf. Since inception of December 2013, QYLD has provided an annualized return of about 5.23%. QYLD follows a broad-based covered call strategy, where the ETF buys the NASDAQ 100 index and then sells corresponding call options. This means that all of the stocks you're getting exposure to through QYLD are large-cap stocks. Of course, take note that QYLD comes with an expense ratio of 0.6%. As expected, QYLD's holdings reflect the NASDAQ index almost exactly, with high exposure to things like Apple, Microsoft, and Google. Number 3, RYLD with an 11.34% yield. RYLD, or RYLD, is similar to QYLD in that the same covered call strategy is employed by the same fund manager, Global X, but this time to the Russell 2000 index and not the NASDAQ 100. This is an important differentiation because the Russell 2000 has more exposure to mid and small cap companies. Like QYLD, RYLD comes with an expense ratio of 0.6%. But it has a slightly higher annual dividend yield of about 11.34%, which are also paid out on a monthly basis. Interestingly, the main way that RYLD gets exposure to the Russell 2000 is by purchasing the Vanguard Russell 2000 ETF, VTWO. You can also see their holdings diversification across various market cap sizes, with most of it coming in to small cap and mid cap companies. Number 4, IDIV at a 12.42% dividend yield. The Metaris U.S. Cumulative Dividends Index, or IDIV, replicates the dividends paid by the S&P 500 without stock price exposure. IDIV is less volatile than the S&P 500 and has a high correlation to earnings growth. IDIV offers monthly dividend payouts with a current annual dividend yield of over 12%. However, the expense ratio is a little higher at 0.87%. The IDIV ETF is a passive investment with no sector concentration. This is reflected in its holdings, which are exclusively U.S. Treasury notes. Currently, IDIV's 5 largest assets are equally balanced at 19% each, and they're all U.S. Treasury notes expiring between December 2023 and November 2027, all with 2 to 2.5% yields. As a small hedge, 2.5% of assets are held in cash. Number 5, ERTH with a 14.19% dividend yield. The Invesco MSCI Sustainable Future ETF trades under ERTH, or ERTH. ERTH includes small, mid, and large cap companies from around the world. They are only eligible for inclusion in the index if they derive at least 75% or more of their cumulative revenue from these 6 areas: alternative energy, energy efficiency, green building, sustainable water, pollution prevention or control, and sustainable agriculture. Companies that have faced severe controversies related to ESG in the last 3 years, or manufacture controversial weapons, are not eligible for inclusion. ERTH purchases and holds shares in these companies long-term, with no exposure via options contracts. This fund also comes with an expense ratio of 0.56%. According to the latest data, ERTH provides an annual dividend yield of 14.19% with quarterly dividend payouts. However, it's curious to see where these come from when you look at its diverse list of assets, which include a lot of growth companies that pay little to no dividends. ERTH has a fairly diverse sector allocation and provides for global exposure. Its heaviest weighting is industrials with 28% exposure. Just over 44% of the companies are US-based, making this largely weighted towards American companies. And the performance hasn't been bad. If you invested $10,000 in ERTH at inception in September 2012, you would have enjoyed a 270% total return to date. Overall, ERTH seems like a good play for investors who want broad exposure to companies that are building an environmentally sustainable future. Due to the wide and diverse portfolio, ERTH generally reflects overall trends in the clean tech sector. However, it's important to note that this massive dividend yield came from a single dividend payment in the second quarter of 2021. Therefore, the dividend yield is probably skewed, and investors shouldn't expect a double-digit yield from this fund moving forward. Number 6. GLCN at 14.8% dividend yield. VanEck's China Growth Leaders ETF trades under GLCN. This ETF consists of fundamentally sound Chinese companies that have high growth potential and reasonable share prices. It currently has an annual dividend yield of 14%, distributed annually. It's important to note, however, that it has a relatively high 1.4% gross expense ratio. After waves and reimbursements, the net expense ratio is a moderate 0.6%. 97% of this fund's 202 holdings are Chinese companies, and the top 10 holdings make up for a total of 37% of the portfolio. All of these companies give GLCN a pretty diverse sector weighting. The holdings of GLCN are rebalanced on a semi-annual basis. Number 7. SDIV at 15.9% dividend yield. The Global X Super Dividend ETF trades under SDIV, or SDIV. SDIV is a portfolio with 130 holdings, all of which must deliver large dividends to be included in the fund. As a cautionary note, this ETF is inherently risky due to its concentration on high dividend yields and the screening process they use to select them. But some of the reasons you might consider SDIV include its high income potential through a diversified portfolio of 130 of the highest yielding stocks, and the fact that it's delivered monthly distributions for the last 11 years straight. It also has global exposure for even more diversification. Note that SDIV comes with an expense ratio of 0.58%. With these things considered, its dividend yield of nearly 16% is quite attractive, especially because they are monthly dividend payouts. As we can see by their top holdings, SDIV provides broad exposure to a variety of sectors and companies. However, it is largely weighted towards financial companies, with over 30% of the portfolio falling into that category. It is notable that SDIV has been rebalanced to focus less on real estate, which previously made up 1/3 of their assets. And as mentioned, this fund is pretty thoroughly diversified internationally, with only about 28% of the portfolio being made up of US-based companies. Number 8. AMOM at 20.5% dividend yield. The Kraft AI-enhanced US Large Cap Momentum ETF, or AMOM, I'll call it AMOM, is an interesting ETF that has provided stellar returns for investors. This unique ETF has a current annual dividend yield of over 20%, which is paid out annually. However, it appears this reported yield is also skewed by a massive dividend distribution in the previous calendar year. Investors likely shouldn't expect this yield moving forward. What sets AMOM apart from its peers is that the fund uses artificial intelligence to determine a company's momentum over a certain period of time. The AI then considers how this would affect the company's performance over time. A key differentiator with AMOM is the ETF's ability to leverage a deep reinforcement learning model that finds and vets valid momentum factor candidates. It also identifies alternative ways to measure commonly used investment metrics. Using this information, the AI recommends a weighting of each company based on its maximum return potential. Momentum investing is a popular strategy for maximizing long-term profits. 1. Buy into trends and maximize returns, with minimal concern on individual annual return potential. 2. Utilize market volatility to maximize returns and avoid or follow movements when necessary. And 3. Identify herd mentality to take advantage of group bias in the market. Due to the AI, which also rebalances the portfolio, holdings change pretty vastly over time. But hopefully this benefits investors as market environments change. Currently, AMOM is heavily weighted towards consumer cyclicals, with large positions in Home Depot, Lowe's, and ConocoPhillips. It also has large exposure to energy with approximately a 27% weighting in the portfolio. Considering the current market climate, investors can consider AMOM's AI-dictated rebalancing to be in line with expectations for the US economy. Number 9. REVS at 21.9% dividend yield. REVS, or REVS, is the Enhanced Value ETF from Columbia Research. As the name suggests, REVS is focused on value companies. Reflective of the general economy, where value-based companies are posting record profits, REVS has provided investors with an annual dividend yield of nearly 22%. This healthy dividend is paid out on an annual basis. REVS follows a three-part strategy, where first, they optimize value equity exposure by investing in highly rated stocks across the Russell 1000 Value Index. And two, they deliver enhanced return potential by outperforming the Russell 1000 Value Index. And three, they offer cost efficiency by maintaining a low expense ratio comparable to benchmark ETFs. The REVS expense ratio is currently 0.19%, which is much lower than its category. Currently, REVS holds its largest positions in companies like ExxonMobil, Wells Fargo, Pfizer, and Meta Platforms. REVS has its highest weightings in the financial and healthcare sectors, but it's pretty diverse outside of those categories. Number 10. OILK at a 26.11% dividend yield. This is the ProShares K1 Free Crude Oil Strategy ETF, which I'll call OILK, and it tops our list of dividend ETFs by yield. With OILK, it's important to note that it does not track the performance of the spot price of crude oil. Instead, this ETF is a benchmark of crude oil futures contracts. OILK comes with an expense ratio of 0.71%, and it provides investors with a dividend yield of 26.11% paid on a monthly basis. With OILK, 100% of assets are held in sweet light crude oil, or WTI, futures contracts. Further breaking down these contracts, we can see that 1/3 of them expire on May 22nd, 2023, another third expire on November 20th, 2023, and the last third expire on December 20th, 2022. Basically, at any point in time, 1/3 of the contracts will expire at year end, 1/3 will expire in the middle of next year, and the remaining 1/3 will expire at the end of next year. The main benefit of OILK is that it gives investors an easy way to invest in crude oil futures contracts. Plus, it comes with a streamlined tax reporting process as there's no K1 form required. And of course, all of this comes in the liquid, transparent, and cost-effective package of an ETF. One thing to note is that while the dividend payout is huge with OILK, it's put a lot of downward pressure on the stock price. This can be seen in the fund's NAV, or net asset value performance, since inception in 2016. An investment of $10,000 in 2016 would be worth just $10,963 today. This equates to an annual return of 1.6% since inception, and is a great example of how large dividend payouts can create long-term downward pressure on an ETF's share value. So it's important to take this into consideration with your overall investment strategy. If you want us to dive deeper into any of these ETFs, let us know in the comments below. Otherwise, check out this video on screen for some of the strongest dividend ETFs available, and stay tuned for the next video.